Welcome to the Mike Litton Experience Podcast. Mike has over 31 years experience in real estate, finance, and investing. He's passionate about being a father, a teacher, a realtor, an investor, and a leader. Everyone has a story, and our passion is to help them tell it. And now, introducing the host of the Mike Litton Experience, Mike Litton.
So what can you expect from the Mike Litton Experience? You can expect stories that will inspire, motivate, advice that will sharpen your focus, and expert information on real estate, finance, and market conditions.
Get into multifamily real estate or commercial real estate.
Yeah.
And all of them are like, okay, you go and you buy this 12-unit complex, you talk to the owner, you get zero money down, all these things. Are like, that sounds magical, but how? Like, it just seems like 1 in a million you're going to be able to find those circumstances, and then you get to write a book because you are the 1 in a million that got it done, right?
Yeah.
But then I started learning, well, you can actually pool your money with a bunch of other investors and get into commercial real estate. So that's what I did. I started investing just some money. I mean, most of these you can do as little as 10,000 to 50,000 for your first time. And you invest. And what's cool about the first time you like these investments is you're learning kind of the steps of what these operators are doing and how they're making things work. So you kind of see behind the scenes a little bit more of like, how are they getting the financing? What's their business plan? You can get you technically can't get involved because you can't be a manager, but you can get as many updates as you want. You can meet regularly with these operators and get to know what they're doing, ask questions. And they're incentivized to answer your questions as fast as possible because they want you to keep investing. So they'll, I learned a lot that way. The other thing I kind of got involved in at the time is because I have this corporate finance background, I started reaching out to some of these operators and saying, hey, if you kind of take me under your wing, I've got the skill set that maybe could be valuable to you. Turns out a lot of people don't like underwriting. So underwriting is the practice of, you look at a property and figuring out what it's worth and how much you could buy it for.
Right.
For me, that's fairly easy because that's what we do day in and day out in corporate finances. We're trying to decide what projects to invest in because you're looking at internal rate of return, what's better than, where do you prioritize your capital stack? So I got into that and I started learning from 3 different operators at the time. One group did industrial, another was mobile home parks, and another was multifamily, and just kind of learned a little bit of the asset classes. And, like all things are serendipitous, it appears. I got introduced to a neighbor. He was just literally down the street in my neighborhood here in the Boise area that was buying a second mobile home park. He was a teacher at the time and had bought a small 20-unit mobile home park in Kansas City area with his wife. They got really awesome seller financing, no money down. So the second one, he happened to just see it like down the road from his first. It just had a sign up in front, no online ads, nothing. And so he needed about 30K down, but didn't have any money. And so one of our other friends and I put the money in. So the 3 of us bought it. So Ryan is his name, the first guy's name. Ryan and I bought it with a third friend. And that's what kind of got me involved in mobile home parks initially. So this other one was another like 25 units. We still own that one. That was about 5 years ago. And so from there, because I had been doing syndications and I'd been learning how to underwrite, I've been learning how to raise capital, and I'd be even doing the SEC filings, all that kind of stuff for these other operators. I started looking at other mobile home parks we could potentially buy that were maybe larger than what you would typically go for. So we found a really awesome portfolio up in the Des Moines area. By the way, what I did is we started building this team in Kansas City for the mobile home parks we already had. And then I drew a 3-hour radius around Kansas City. I said, we need to use the same team. Let's start with Kansas City and kind of build. So we found the Des Moines project about 2.5 hours from Kansas City, bought that. That was our first syndication. We raised $3 million on that. And I'll maybe if you're okay with me going into detail, I'll kind of say how we did it, because I think the first one is challenging to get the first one done.
Yeah. I mean, everybody wants to hear this. So absolutely, go ahead.
So again, the first mobile home park that we bought, we just put some money down and then had seller financing to get the deal done, but we still had to have a down payment, right?
That was Kansas City, right?
That was the Kansas City, the small Kansas City one. Yep. The second portfolio, we bought it for, I think it was about 6.4 million was the full purchase price for, I'm going to get the numbers wrong, but it was about 280 units, 280. You say pads because it's the dirt, right, that you're buying. So about 280 pads. So we were able to get traditional financing from a regional bank there for 80%. and so we had to come up with a down payment of 20% plus you want some operating reserves, plus you need some capital reserves because you're going to do some improvements. I mean, we can get into more detail than this later, but even as much as like if you have a vacant lot, you've got to estimate about 20,000 to get concrete, piers, move a home in, all those kinds of things. So it can be costly to do these upgrades. So we ended up having to raise something to the effect of about 3.4 million. So I'm coming from, I just put 15K down on my first mobile home park to now I have to raise 3.4 million, right?
Right.
And the way we were going to do it is we had some partners that were willing to bring the capital in with us. So they had their own investors that were willing to come in. We also had talked to the owners of this mobile home park. There were 3 of them, and 2 of them somehow they saw us. They saw themselves in us. In fact, one of them tells me all the time, "You're me 20 years ago or 30 years ago, however old the age is, right?" So he just like really like trusted us and felt like a lot of kindred spirit from us. And the 2 of them started talking to their friends, and they helped us raise some money for this deal.
Wow.
Which ended up being a blessing because not even a month before we were closing, that major partner that was supposed to bring in capital said, "Just kidding, I'm not bringing anything in."
Wow.
And so
Wow.
we had to suddenly find a way to raise all 3.4 million without a larger partner, right?
Yeah. Time to
And
pivot.
so
Right?
yeah, so it was hard, but these two guys really helped us cover that gap.
Yeah.
And so it was a lot of talking to friends, talking to family, pulling out the Rolodex, talking to people, and like really showing people our passion and all the homework we had done to show that this deal was going to work. Our projections, our business plan, all those kinds of things, and it helped. We ended up getting the deal done, which was great. So since then, we have now 26 properties. Most of them are mobile home parks, a few are long-term RV parks, all cash flowing, doing great, have some really happy investors. And yeah, mostly in the Midwest. We're mostly in that Kansas City 3-hour radius that I told you about.
Okay. So question for you.
Sure.
On that first deal, what's the number one thing you learned? Most important.
I am going to say grit. Like you've got to have a ton of grit in this space because, and every single deal, maybe I shouldn't say every single deal. I've had a couple that have been very smooth, that have just like, by the book closed. But again, talking 26 properties now, it's rare that they go by the book. There's always messes. I had just side story 2022 when rates were coming down, we had the deal of our lives that almost fell apart because the rates kept going up. And we just, like, economics kept changing, but I believed in the deal and we got it done, and I aged probably 30 years in that 6 months that we were going through it. But the point is, you got to just have a ton of grit and confidence in yourself and faith in your team, and do what it takes to get the deal done. For us, the hardest part is still coming up with the capital stack between the bank financing and the investor piece of it. Now that we've had more experience and more success, I think the investor piece is becoming easier because people see, okay, we trust you. We've seen your deals. We know you can do this. But when you're first getting started, it can be hard to get that.
You have
so
a
I have some
track
tips
record
for
now. You
listeners
didn't
if
have
you
that
want. But
before.
yeah,
Yeah.
exactly. The track record's key. So it's hard when you're first getting started without that track record, though.
So what's the number one thing if somebody's thinking about doing what you're doing? What's the number one thing they should watch out for?
Oh man. I thought you were about to ask me what's the number one tip, and so I may answer
Well,
it the same way both ways.
You can do both.
So the tip that I would suggest if somebody's trying to get into make a big jump into a new asset class they've never done, or go from single family to maybe like a multifamily project or something, if you find a project that you really believe in, I think finding another group that's done it before and convincing them of your vision and having them help you is the way to go, because you get to take advantage of their track record. You get to take advantage of the fact that they can help you de-risk it a lot because they've got the skill set, they've got the network, they've got the connections. But that's also the thing I've learned the most. I've made several partnerships that have fallen through where the other partners didn't hold up their end of the deal. And what can be tricky, and Mike, obviously you've probably lived this and done this yourself, maybe not made this mistake per se, but what can be tricky with partnerships is you come up with this share class or this agreement of who owns what the percentages are. And if somebody doesn't follow through, unless you've written in the agreement what the penalty is for not following through, they
Right.
potentially still get the same incentive regardless. So
Right.
we had some where we were giving up a chunk of deal to people that were doing nothing,
Yeah.
because we didn't build in that structure. So we've definitely learned over time that you've got to have these incentives. And I actually took a page from technology. It's common to do RSU structures where you get an earn out over 4 years, for example. So
Right.
if you do XYZ, you get this. And so that's what we've started doing. Where, for example, in the mobile home park space, you can have some really easy metrics that say if once occupancy is to this, then you get this,
Right.
and so you're kind of tying their incentive to occupancy if that's their job, if they're in charge of bringing in homes and selling units, rather than just, hey, you get this. So
Yeah.
that's been big.
So it's a performance clause issue.
Yeah,
So
exactly.
you need to have performance clauses in order to make sure that the people that are in that share class are in fact carrying through with what they originally said they were going to do. But you
Right.
put it in writing, right? So that if it doesn't happen, you have an enforceable mechanism that you can then go back to and say, look, you're out. You didn't meet these metrics.
Right. Exactly. And it just makes it so easy because they never challenge it. They're like, you're right. Okay. Right.
Yeah.
Like it's not when you have it clear in writing, you don't need to go any kind of legal action because they get it.
You mind if I ask you something?
Sure.
So when you're evaluating potential partners, what's the most important thing that you look out for when you're evaluating potentially bringing a partner on?
I really want to know they have integrity. That can be
Mhm.
hard to get from just kind of getting to know someone initially. So if you just meet somebody at a conference, you're not gonna be able to tell how much integrity they have. But you can talk to references, you can check other people that know them. Um, Ideally, you've worked with them for a while. So I now have the benefit that I've been working with all these people for 5 years.
Yeah.
So I know who will perform and who's gonna like really who I can count on.
Mhm.
And that makes a big difference. But when you're first getting started, it can be hard. So I think the way to go is assume it's going to fall apart, and so write your agreement that way. But
Mhm.
hope it doesn't. Work like it's not going to. But you write with the intent with the assumption that it's not going to work out. So that again, there's clear responsibilities and clear expectations.
Yeah, and it's not, we all want to think of ourselves as optimists,
Yeah.
right? Like there's a movie that just came out about Ronald Reagan, and they talk about what an optimist he was in the movie. And he was an optimist. But what was interesting about him was he lived and worked by the rationale and the rule that you trust but you verify, right?
Yep.
And it's important that people understand that just because you're going into this expecting that potentially it might fail, right? You're going into this doing that to protect yourself. It's not necessarily negative thinking, it's just making sure that you're protecting the downside.
Right.
Kiyosaki talks about you protect the downside, the rest of it takes care of itself, right?
Yeah.
That's what investing is all about. That's what being a success is all about. Is you do the best you can possibly do to try to handle whatever the potential downside is, address that, take care of it, and then let the upside do its thing.
Yeah.
So
Absolutely. And the other thing too that you made me think of too with that is part of like outlining the rules and expectations helps people be happy with the agreement too,
yeah,
because we've all seen those partnerships a year in, 2 years in, where there's some animosity because one partner feels like they're doing more than the other partner.
right,
And so you've also got to have kind of that alignment like pretty frequently where you're continuing to say, okay, how are we doing? Are we both? And you kind of hold each other accountable, even in the best, like you're both have high integrity situations. Because, just like in a marriage, my wife can't read my mind. I can't read her mind. We've got to make sure that we're communicating and saying, hey, here's an expectation I had that maybe you weren't aware of.
right.
Um,
So when you're working with a partner and you're agreeing to hold each other accountable, are you getting permission from those people to hold them accountable?
yes. Yep. So, and you set that expectation ahead of time too.
Yeah,
So,
that's a big deal.
yeah.
It's a big deal because none of us want to be held accountable,
Right. Right.
right?
Exactly. Yeah.
It's
For
true.
sure.
It's true.
It's
We're
true.
adults,
Yeah.
right?
We
Who
all
are
say
you
we
to
do,
who are
but
you to
nobody
hold me
has fun with
accountable,
that.
right?
Yeah. Yeah.
But if you ask permission and they give you permission, it's a completely different deal, completely different playing field,
Yeah.
right? So yeah, it's incredibly important, and I want people to hear that, because a lot of the people that are listening to this have never done what you're doing. They might be interested in doing what you're doing, right? It might be one of the reasons they tuned into the podcast. The thing is, they need to understand the dynamic of this is how human nature is. And the way and by the way, it works with your kids and with your wife, just so we're clear, right?
Yep.
If you get their permission to hold them accountable, then when you hold them accountable, it's not this major blow up. It's not this, people are getting offended and all that kind of thing. It's, we talked about this, you gave me permission, now let's talk about accountability, right?
Yep.
And it just puts everything on a completely different level, and it's really, really cool. So let me ask you this. What does tomorrow look like for Suncrest, pardon me. What does tomorrow look like for Suncrest Capital?
Well, most immediately, we have a project we're closing on in a few weeks. So about last year, I told you most of our properties in that Midwest.
That 3 hour,
Last
yeah.
year, yeah, last year we found an amazing deal down in the New Orleans area. So we
Okay.
closed on that in October, and it was such a great deal that we started cold calling around by the owners in the area to try to find another off-market deal that we could get.
Yeah.
And we found one that's going to be closing here in about 3 weeks. And what was cool about that, by the way, Mike, this is the first time that we were able to raise all the money in a week. So
Wow.
we started letting investors know, and it's finally. I've had several mentors that have told me it gets easier. It gets easier. And I
Yeah.
wasn't believing them until about this week. I'm like, okay,
Yeah.
finally,
Yeah.
I see it's getting easier, right? On
Yeah.
like you said, the track record, right?
Yeah.
So that's where we're there. We're getting to the point where over the next couple of years, our assets are being ready to be repositioned, meaning we're able to start refinancing them.
Mhm.
We're just waiting for some rates to come down.
Yeah.
So as rates start to come down, we'll start to reposition some of our assets. We've been pretty slow from an acquisition standpoint in the last couple of years, especially with rates being up and post-COVID environment. It's been rates have been up, but the prices are still up.
Right.
So the sellers are just kind of not reconciling that. So this is only our second acquisition in almost 2 years, where before we were buying 6, 7 properties a year before
Yeah.
that. So I definitely want to pick up the pace a bit on acquisitions once we see that environment change. So we're doing more and more off-market sourcing to try to find the better deals there.
Yeah, and as interest rates come down, it gets easier, right? It's you've got
Yeah,
more flexibility, you've got more cash flow. So it's one of the things that we talk about a lot. And the reason we talk about it a lot is because people don't understand until they've lived through a time like this, where you have really high inflation and you have really high interest rates. Really high inflation is a tax that's like a silent tax. It's something that people don't realize. They go to the grocery store and they buy $200 worth of groceries that they used to spend $100
hmm
on.
yeah,
Eggs are up in 3.5 years, eggs are up 98%.
it's nuts.
Okay. That's the kind of thing that people start feeling. You go to the gas pump, and instead of it costing $50 to fill up your vehicle, it's $100, right?
Yeah,
That's something that people start feeling on a regular basis, and eventually they get to where they have more month than they have money left, right? And so that impacts people investing. It impacts people in terms of their decision making and what they're doing, right? The amount of money that they have left over, and what kind of stress they're under. And so when interest rates come down and inflation comes down, it helps to ease things all around everywhere, right?
for sure. Yeah,
And so that becomes one of those things where now you have owners that you can talk to who are more likely to think about selling. Whereas during this last 3.5 years, they've been just holding on. They've been white knuckling it and trying to make it through.
yep,
So it's a completely different dynamic, right? And you're going to have situations where you're going to have sellers that are ready to move on. And they're ready to move on because they have a confidence in the economy as these other things continue to equate and sort of calm back down. So you positioned yourself in a great place to take advantage of all that. And I'm super excited for you, man.
thanks, thank you. Yeah, it'd be nice to see that. One thing we definitely learned through that process, we were fortunate to have fixed rate debt on all
Yeah.
of our assets. So some of those are, ours are 5, some are 7-year terms.
Right.
I think even as the rates come down, one thing I've learned is that you've got to, you can't assume they're going to stay down.
Yeah.
I saw too many underwriting models in 2020 to 2022 where they were assuming that they were going to be refinancing and selling at the same interest rate, so
Yeah.
3% forever, which is just not realistic.
Not even
really in
remotely.
any environment. Yeah, exactly, exactly.
So again, we go back to that same thing you talked about. You take care of the downside, right? The downside is interest rates are going to be 6, 7%. You
right,
take care of that downside, and then you let the upside take care of itself, right? Just let it go. It does
exactly.
its thing, right?
Yeah, yeah, and
So,
that's exactly how we underwrite. Is what the first thing we've learned over the last few years is we've got to assume we can't buy any assets that aren't cash flowing. This is
yeah,
where we started at the beginning of the conversation, right? Where I used to be, oh well, as long as it's paying the mortgage, I don't care if
yeah,
I'm making money. That's not good enough anymore.
yeah,
We've got to be making our rule is 6% day one, but we've got to have a clear path to get to 8 to 10% by the end of the
yeah,
year. And we lose a lot of deals by that because there are plenty of investors that are okay taking 1% or even negative for a little bit. Especially some of these institutional investors that get cheap money, they don't care about the
yeah.
cash flow, at least for the first little bit. And so that's okay. I'm happy to lose out on deals. We just want to make sure we're getting that cash flow at the beginning because that's what helps us sleep at night.
I know that this is probably completely out of left field, but I'm really good at completely out of left field, just
Oh,
so
I
you
get.
know, right?
Yep.
So here's are you okay if I give you a bit of advice?
Yeah, please do.
Okay. So one of the things that I would do is keep a log, keep a database of the deals that you didn't get, where the investor came in and they bought it. Your rule was 6%, theirs was less. Because here's the thing, as time goes by, those are potentially going to be aggressive sellers.
Good point.
Okay. Think about it. They're going to run into a place where investors are going to balk at them. Because remember the free money thing?
Yeah.
Remember the free. Okay, so I'm going to give you an example. Okay, have you ever heard of TRX training systems?
Yeah. Yep.
Okay, so we had Randy Hetrick, who founded and owned TRX, built it up. Private equity firm came in, bought him out. He turned around and repurchased the property, repurchased the company. So he now owns it again. So they bought it. They bought it with that cheap, easy money.
Yeah.
Okay. 3 years later, or just a few years later, they're coming back to him and he's buying it back.
Wow.
You with me? So
Yep.
think about it
Yep.
that way. You could be a year away from getting an incredible deal from easy money investor. Okay.
Yeah.
So
Yep.
what I would do is stay in touch with them as best you can, but stay in touch with them and let them know, hey, if anything changes, we're a buyer. If anything changes, we want to be your first call.
Yeah.
Okay.
I like that.
You'll be able to
Keep a
snag,
list, so that
yeah,
wouldn't be
you'll be
hard to
able
go
to
back and
snag
do it.
deals like you can't believe, because they're going to get to a place, because here's what happens. That easy money thing is investors' money. Those investors at some point may very well rebel. You've heard of these activist investors and all that kind of
Yep.
thing, right?
Yep.
You've watched them do their thing. It's happening with a bunch of different companies right now, right? Where the board's trying to fight them off. Okay. Where
Yep.
they're literally accumulating enough to do a hostile takeover, that kind of thing, right? Leverage buyout, whatever.
Yep.
If you stay in touch with those easy money sellers, at some point, if that attitude of those investors turns sour because of some other geopolitical thing, right? Over in Dubai or whatever, right? Or in Syria, what I'm saying?
Yeah.
All of a sudden, they may very well be an aggressive seller, and you might be able to snap that thing up for a song.
I like that. That's good advice. Thank you.
Okay. I would also stay in touch with the lenders that lent on it too, because lenders, when the note starts to go non-performing, they're looking to sell that note. I would be the buyer of that note if I was you,
Yeah. Good
right?
call.
So I'd stay in touch with them. They get a non-performing note. I can tell you a story about something that happened out here. We don't have time for it, but I can tell you a story about something that happened out here where a guy got five properties from one note that he bought. That was a
Wow.
non-performing blanket mortgage. And all 5 of those properties were golf courses out here. And all 5 of those golf courses are now being developed and there's houses going on those courses. Okay.
Wow, that's awesome.
He
Yeah,
did
it's great.
incredibly well by buying a non-performing note from an investor, right? Because the guy got into financial trouble.
Yeah. Yeah. That's awesome. Well,
Okay.
yeah, thanks for the advice.
Just something to
Appreciate
think about. Listen,
Love it.
I cannot thank you enough for being our guest on the Mike Litton Experience. This has been a lot of fun, and I really, really enjoyed our time together.
For me too, Mike. That's super fun. Thanks for having me.
Thanks, buddy. Stay in touch, okay?
Yeah, I will.
We hope you enjoyed another episode of the Mike Litton Experience. If you did, do us a favor, smash that subscribe button, tell your friends, family, and coworkers about our program, and wherever you get your podcasts, please leave us a rating. It helps us to connect with quality people just like you.
And that's a wrap. Another episode of the Mike Litton Experience in the books. Reach out to Mike on Instagram at Litton Realty. Want to meet with Mike? Check out calendly.com/Rio760.